Hi everybody, this is Sean Overton with OneStepRemove.com. In this video I'm going to give you a light introduction to our position size analysis software. The goal is just to show you over, if you know what the expectation of your system is in terms of percent accuracy and payout, we can give you a model of what kind of returns you might expect purely due to random chance. I'm going to go over the parameters in this software, and then in future videos we're going to go over different combinations that you can consider to analyze your trading system and even random luck. So to start, the first column here is the initial balance, and that ought to be straightforward. It's the amount of money in your account. The next one is the winning percentage. I think that's also straightforward. Here we're going to win 50% of the time and we lose 50% of the time. The R multiple is the ratio of the wins to the losses, and that's the amount that you win divided by the amount that you lose. In this case, I'm setting it to 1, and if you're still not comfortable with that, you can take it straight from your back test. If you're familiar with NinjaTrader, you'll notice that there's an analytic here that says the ratio of the average win to the average loss. In this case, it was 0.68. That is the R multiple. It's the exact same thing. Here, it's we win $1, we lose $1. In this next tab, it's the amount of risk. So for a $100,000 account balance, we're risking 1%. That means when we win, we're going to make $1,000, and if we lose, we're going to lose $1,000. If we set it to 2%, it means we make $2,000 or we lose $2,000, etc. The next two tabs are a little more tricky. The trades per run, and then the number of runs. So the trades per run is analogous to a coin toss game. So with our 50-50 odds and a 1-to-1 payout, I'm going to flip a coin 200 times. Whenever I come out heads, I'm going to record that I upped the balance by $1,000, and whenever I come out tails, I'll deduct $1,000. After I've done that 200 times, I'll record the final balance. So maybe it comes out to $95,000. Okay, I record that and I save it. Now I'm going to go on to the second trial. I flip a coin 200 times. I record the change in the account balance over and over again. Once I get to the final result, then I'm going to write it down on my list. I'll say we wound up at $102,000. Now I'm going to do that 2,750 times. That, if you notice that this times this, is going to wind up to the number of random numbers in our file. And what we want is we want to make this number as large as possible in order to give us the expectation over a certain number of trials. To put that in trading terms, if you do 200 trades and you have a set expectation, that might be the equivalent of your trades per year if you trade less than once per day. If you day trade and you do 5 trades per day, then this is the expectation that you would expect after 30 trades per week times 10 weeks is about 300. So about 6.5 weeks is what you expect your return to be after this much trading. It's going to fluctuate due to random chance, and that's the whole goal of using this software. The last thing I want to explain is how the random numbers in the software work. We're reading them from a file, and the file was generated from atmospheric noise. So what that means is you just take the noise, you come up with a bunch of bits, and you turn it into a random number between 1 and 10,000. We read the first number for our trade, and we say, okay, we have a 50% winning percentage. If the number is between 5,000 and 0, then we're going to accept that as a winner. And if the number is above 5,000, we'll throw it out as a loser. If we changed our winning percentage to 65, then we would say if the number is between 1 and 6,500, it's a winner, and if it's more, then it's a loser, and so on. And just by having that random chance, we can very accurately model the accuracy, and because we control the account balance, we can come up with very accurate expectations of how random luck can either work for us or against us. And I'm going to push calculate just to put the numbers up on the graph. And you'll see here that we did our analysis on over 500,000 random numbers, in this case 550,000, with numbers between 1 and 10,000. And it gives us this nice little statistical analysis that verifies the results that we would expect. So the average winning run is it was exactly 2. And the average losing run is almost exactly 2 as well. It's perfectly balanced, which is what we expect. Here you have a random run of 17 consecutive winners purely due to random chance with 19 consecutive losers. This number is never going to precisely equal 50%. It should just be very close. And here we're accurate basically, well, I mean, yeah, within hundredths of a decimal place. It's very good and it's enough for the analysis. So I'll leave a video here, and in the next video we're going to actually talk about these outcomes and how a 50-50 coin toss game can make or break your account if you're risking too much. My name is Sean Overton. Thank you for listening.